Welcome back to the second half of our Saturday program. We're going to, the topic for this half is sustainable investing is for every investor who wants to manage risk. And managing risks, I think, is a big part of this. And the areas that will be covered are how sustainability integrated portfolios provide better risk-adjusted return, why this could be a great time to align your companies, align with companies solving the world's biggest challenges, and how to determine an investment's environmental, social, and governance, ESG, score when there is no standard. So, Janet, you have the floor.
Very much. Yeah, there is no standard. It's developing. This is a new area. I have been doing it for about 25 years, and it's come a long way. But it is frustrating that there's no standard. I'm going to hope to just really share with you what I do in managing sustainable portfolios in our sustainable fund, and give you a little background and show you some of the tools that we use, and just again, share what I know. So all investments have a real world impact, and we can use our investments to bring about positive change. So at Fundex, we really help our clients think not only about their goals, but what kind of companies they want to support, because our purchases do have power. Where we invest our money can be a vote for the values we want to support. So these days, it used to be called socially responsible investing, and now it's sustainable responsible investing or impact investing. And it's one of the fastest growing areas of the fund industry. More and more investors see it as a better way to invest. I wasn't sure how many people would be joining for the first time, but so I put in these slides of who is Fundex. We offer guidance in the form of a monthly newsletter. We also manage money. We've been managing sustainable portfolios for about 20 years. We publish Fundex Insights. We have a very well-defined strategy called upgrading, which is focusing on what's working. This very same strategy can be applied to any universe of funds. What you're seeing here is a diversified group of core class 3 funds, which includes sustainable funds, but it's not only sustainable funds. Back in 1980, there weren't very many of them, but I'll show you some more. So, as I said, a decade ago, this was called socially responsible investing, and the term had an air of do-gooder, an investor who wanted to make money, but also change the world. So I think most of us now believe that there's a much broader sense to identifying and living our values. It's now more important than ever. Most of us can agree we want a safe, healthy, prosperous world where people are treated fairly. More importantly, we expect brands that contribute to our social welfare to prosper. There was a recent survey that reported the majority of consumers now believe that brands are more powerful than governments when it comes to addressing social issues. So corporate social responsibility is a crucial component to many consumers, especially younger ones. So when I talk to clients, I mean, wondering what they can do toward that end. Many of my contemporaries want to redouble their efforts to contribute to a positive change in the world. And one very simple contribution we can all make is to realize that our purchases have power. Where we spend and invest our money can be a vote for the values. So it's interesting to me that many people will be so very careful about the purchases in some areas, food or clothing, and for their investments, they're not as aware. Even some of the foundations where I manage money, and this is changing rapidly, but not too many years ago, many foundations were just kind of indexing, keeping their money in index funds with no regard to what they were supporting. So ESG is helping us identify what we can do to have competitive returns and also positive societal impact. I said in the last section that the US economy coming out of the pandemic is very different than the one that went in. And one of the huge implications is that sustainable assets are becoming more and more popular. There's certainly a growing societal preference for sustainability. The end of the peaceful period between the, I'm still just kind of locked on the news about the war, and so many are saying that the peace dividend is gone away. The end of the peaceful period between the end of the Soviet Union and the invasion of Ukraine means the period of globalization has ended. I don't know that it's going to be ended, but it's certainly diminished. And there's this growing societal preference for sustainability. Certainly the weather extremes, the impact on us just can't be denied. Code Red for Humanity. Last week, the IPCC reported climate breakdown is occurring quicker than anticipated. And at current levels, many parts of the planet will become unlivable in the next decade. The IPCC represents 195 governments. It's an intergovernmental body of the UN responsible for providing policymakers with scientific assessments on the risks and implications of climate change. Their reports are peer-reviewed assessments among hundreds of climate scientists and experts. The current UN Secretary General Antonio Guterres said, "I've seen many scientific reports in my time, but nothing like this. This is a code red for humanity. We must combine forces now to avert climate catastrophe." In many cases, it's still technically possible to adjust for climate-altered conditions, but barriers such as costs or policies stand in the way. The IPCC calls these soft limits to adaptation. With hard limits, there are no clear solutions. Biologically, humans can cope with only so much heat. Low-lying islands will eventually be engulfed. Some plants and animals have already hit hard limits, such as coral reefs. This is a dire report, but it's certainly emphasizing the importance. ESG risks have certainly moved to the top of the agenda. The World Economic Forum lists the 5 global risks, and you can see the green, they're moving up and they're there. And addition to broad sustainable practices, companies related to specific themes like clean energy are certainly poised to grow, certainly after the invasion of Ukraine and the oil crisis. This slide was created before the war and the third oil shock started. And this estimate showed, one estimate projects that 2 trillion in new investment would be needed over the next decade to implement renewable energy targets that have been set globally, but certainly this will be accelerated. So, I mean, right now we're seeing old oil companies, energy, you saw at the top of our ranks in our funds, but I mean, most everybody thinks in the next 20 years that will be completely reversed. And I think that the war is going to do nothing but accelerate this growth in clean energy. More broadly, looking beyond energy, there's a consensus around United Nations Sustainable Impact Goals, Sustainable Development Goals, SDGs is what they're called. The Principles for Responsible Investment was launched in 2006. And the preamble for those principles said that we recognize that applying these principles may better align investors with broader objectives of society. So never before have these broader objectives of society been more clearly defined than with these SDGs. All the countries of the world have agreed on a sustainable agenda covering 3 broad areas: economic, social, and environmental. And it comprises 17 goals that you see here, further developed into 169 targets. So this is just a way to make clear and to sort of organize this global community to solve some of the most urgent problems the world is facing. There are mutual funds that specifically align to target these SDGs. Here's another way of helping look at that. So I think I've already told you why the ESG concept was popularized by large banks, basically to manage risk. Successfully forecasting long-term market sector entity-specific trends increasingly requires a comprehensive understanding and relevance of these ESG factors. ESG risks have a material financial impact on companies. Obviously, climate change can disrupt global agricultural supply chains and have an effect on bottom lines. There are also breaches in social networks, and share prices suffer as a consequence of a lot of ESG things. So ESG really presents a framework for better understanding these risks. Historically, these kinds of risks weren't discussed in company financial reports, and now most all companies are reporting. Just to sort of back up, you can see that ESG analysis includes assessment across a number of factors within each of these pillars. Each of these 3 pillars are integral, for instance, to the Volkswagen blow up, but it wasn't actually the environmental that was most important there. In fact, analysis from an environmental lens may not have been able to detect a red flag since the company was reporting falsified data on its carbon emissions. The most important lens would have been G, governance, which looks at corporate leadership practices and behavior. I think that's become a lot more visible and important lately, as has social, you know, in the last few years, where racism and inequality has really come to the forefront. Companies have started to really wake up about social. And so it's just a tremendous benefit that most all companies in the S&P 500 are now reporting ESG scores. So analysis across ESG expands the scope of financial analysis to reveal both risks and opportunities. For example, companies exposed to increasingly frequent extreme weather events face disruptions. And companies that produce poor quality products may face costs related to recalls, litigation, reduced consumer loyalty. But the opportunities are vast too. Companies developing products to improve water efficiency is a huge opportunity when we're facing worsening water scarcity. The obvious opportunities in clean tech, EVs, battery technology. This hopefully makes intuitive sense because sustainable investing doesn't throw out traditional financial analysis at all. Rather, it supplements it. It just provides an additional lens. So consider two companies that have the same characteristics according to traditional measures, but differ on ESG on the right. Which one would you expect to perform better? It's obvious. So I think the perception is changing, and ESG is certainly just not the do-gooder anymore, but that's the main point I wanted to get across. And here, sustainability equals profitability, I think is fairly obvious too. Happy workers are more productive. A company that exploits either its resources or people may face fines or lawsuits, and that really hurts the bottom line. Higher revenue comes from successful products that solve pressing human needs. Population growth is fastest in lower income economies, and new customers from these economies seek out lower priced products or higher value, you know, like the solar energy stove. Procter & Gamble's single-use shampoo customizes a smaller package size to achieve more affordable hair care for everyday families in places like India. In that market, 70% of all shampoo used in India is from single-use sachets. It's become a multi-million-dollar market. Oral hygiene for these customers also is repackaged. And hygiene in general is being improved, a wellness benefit. Certainly lower costs. Interface saved a cumulative $400 million while embarking on energy efficiency materials reduction and waste reuse and recycling. Certainly tax incentive, optimal taxes. Walgreens, an example. They've adapted more than 100 of their California, New Jersey stores and at least 2 distribution centers and took advantage of renewable energy state tax incentives. Investor demand is another huge one. United Technologies started publicizing sustainable products, like its more eco-efficient buses and zero energy building design, and its stock price started to move up faster than the industry average. It's really being rewarded. There's certainly a growing recognition for sustainability. Companies are disclosing more information. So over 90% of S&P companies are disclosing ESG information now. And this is information we simply didn't have as much access to at the beginning of the decade. Large institutions like the central banks, public pensions, and insurance funds are recognizing that sustainability risks are investment risks, and they're integrating these into their investment process. One survey I saw recently showed that 70% of institutional investors are already implementing ESG. And Morningstar did a survey recently that found that 72% of US population expressed at least moderate interest in sustainable investing, with over 50% had a highest level of interest. So this is a huge change in demographic. It used to be primarily women and millennials, and it's really growing. So ESG analysis is critical to risk management, but we believe there's also tremendous opportunity here. This is a Morningstar study showing that allocating to their group of sustainable funds here in the green does not result in weaker performance at all. You know, that was the old criticism of SRI funds, that you gave up performance. Well, today we can prove to you you don't. There are many studies showing that that is simply not true. This is an average of Morningstar's traditional funds versus their ESG leaders. There have been more than 2,000 studies showing the link between positive performance. Here I'm showing you the performance of ESGU, annualized performance, and this is right up to date. It's not a huge outperformance, but if you take the S&P 500, and this is the annualized return from 2016 to 22, you can see that this ETF, which is BlackRock's ESGU, outperformed. And increasingly, investors are accessing these. It's certainly a changed world. The COVID crisis elevated the importance of ESG. So basically today, ignore at your own peril. One way for you to find ESG scores is through Morningstar. Back in 2016, they released their Morningstar Sustainability Rating to help investors use it. They used to use Sustainalytics to provide their data. I will say that of most all the fund managers I use, they really believe that ESG is a starting point only. We use both Morningstar Sustainalytics and MSCI ESG ratings, but there are differences, and materiality is a big deal. So most all fund managers that I talk to take an ESG rating. They might take all of them as a starting point, but they really do their own research. They're more and more coming available, and they're, as we've noted, they're people working on standards. It's sorely needed. FASB and a lot of, I'll show you some other organizations that are working on this, but for now, Sustainalytics is one of the places where you can get ESG ratings for free. Several of the other companies charge, and probably MSCI is, the cost is outside of most individual investors. But I think back in 2019, Morningstar enhanced their sustainability ratings, and they now have risk ratings. But they essentially, historically, they had these globe ratings that they would assign to funds. MSCI ESG ratings are more in depth, and they measure a company's resilience to long-term financially relevant ESG risks. They leverage artificial intelligence and alternative data to deliver dynamic investment relevant insights. So it's designed to assess the resilience of a fund's aggregate holdings to long-term ESG risks. So they come up with a fund ESG quality score, and it's assessed using the underlying holdings overall ESG score. So overall ESG ratings and overall ESG ratings trend. It's been shown that the trend is actually more important than the rating itself, and it's calculated in these 3 steps. The ESG quality score is mapped out to AAA to CCC. And then the momentum is a gain insight into a fund's ESG track record, designed to indicate the fund's exposure to holdings with a positive rating trend or worsening trend year over year. And then tail risk, understand fund exposure to holdings with worst class ESG. So ESG is certainly a valuable way to, as a starting point. And these strategies for implementing sustainability into your portfolio include integration of ESG factors. Equally important, I think, many people think more important, is stewardship, or really actively engaging with the companies. I'm on several committees for large investment pools. In fact, I'm on a committee that I'm honored to be on because it includes the pioneers in this field, the people that filed the first ever corporate resolution. It was an anti-apartheid resolution more than 50 years ago. And things have changed dramatically in the last 50 years, because now the same committee files, Mercer Investments is helping us do this, but file corporate resolutions every month, like 9 or 10 every month. And we don't believe that screening out the controversial companies is really the most effective way. That's kind of an old style of sustainable investing. We actually own shares, not a lot, but own shares in companies that we want to engage with, because often shareholder advocacy can help management to improve their policies. And we've seen lots of examples of that. And I'll show you an organization called As You Sow that does just that. That's sort of setting up my recommendation to you that if you don't have the time to do a whole lot of research on the funds that you invest in, you can simply invest in funds with higher than average ESG scores. And that's not a bad place to start. But I think that more and more my firm is going to aligning with fund managers in our funds of funds that actually do the advocacy work, that actively engage with companies that they invest in, because I think that's probably the most effective way for change. I put this in to show you some high profile examples of ESG risk. This is how you could have avoided, for instance, the Volkswagen emissions scandal. A lot of these are looking dated now, but you get the point. There was a $15 billion judgment. The share price was down 37%. Volkswagen, J&J, Vale, Iron Ore, Boeing, and PG&E are all companies you would have avoided had you simply paid attention to their ESG scores. In each case, the share prices tanked. As I said, shareholders are a powerful force for creating positive, lasting change in behavior. As an investor, you have a say in what a company does. Investors and the funds they invest in bring important issues to the attention of company management. And this wins media attention to help educate the public. It changes how a company operates by voting, helps companies move forward with progressive shareholder resolutions. So Americans are voting their dollars now more and more, and we are seeing actual change as a result. The more people join in, the greater the impact will be. So As You Sow is the nation's nonprofit leader in shareholder advocacy, and they have a terrific website. It was founded in '92. Their mission is to promote environmental and social corporate responsibility through shareholder advocacy, coalition building, and innovative strategies. Some examples of what they've done. They began engaging bottled beverage companies 15 years ago to encourage them to improve their bottle and can recycling rates. After dialogue and filing proposals for several years, Coca-Cola agreed to recycle 50% of its glass bottles and aluminum cans. Pepsi-Cola agreed to an industry recycling goal too. They met their goals and then increased it. That means something like 20 billion bottles and cans are avoiding landfill just because of As You Sow. Another example is Target. As You Sow went after Target. The issue is toxic chemicals in toys. Amy Domini was a pioneer in the industry, and she's still a company called Domini Social Index is now owned by another company, but there's an ETF DSI, which stands for Domini Social Index, and it's one of the oldest screened ETFs. Anyway, the Domini fund managers engaged with Target to reduce the toxic use of PVC plastic and children's products. So the outcome was not only fewer harmful products, but Target has a whole sustainable product standard now. Calvert funds engaged with electric utilities, and the outcome was over 50 major corporations committed to source 100% of their power from renewables. Home Depot, Trillium is a fabulous firm that it's a money manager in Boston, and they engaged with Home Depot, one of the largest retailers of old growth lumber at the time. They agreed to use more sustainably sourced wood, and this is a little old, but they sold more Forest Stewardship Council certified wood than any other company in North America. This is a group of nuns, but I put the website on here, Investor Rights Forum, case studies. Demonstrating positive impact of shareholder proposals. There was a group of nuns, actually. It began as a suggestion from a county health official to leaders of a group of nuns money management group. They were addressing climate change, modern day slavery, and immigration. Why not the opioid epidemic? So a year and a half later, the coalition of investors born from that idea wields 2.2 trillion of influence, urging the largest US drug companies to take accountability for playing a role in the opioid crisis. The group Investors for Opioid Accountability cut deals with companies in the business of making or distributing opioid painkillers to review how they oversee sales. So it's made a real difference. This is an old quote by Supreme Court Justice Louis Brandeis. No such thing as an innocent shareholder. He may be innocent in fact, but he cannot be held innocent socially. He accepts the benefits of the system. It is his business obligation to see those who represent him. These are the leading ESG issues. You can see that proxy access, corporate political activity come before even environment. Labor and equal pay, executive pay is a big one. As You Sow does a huge, important report every year on executive pay. You probably know that since the 40s, executive pay as a multiple of average worker pay has grown to over 340%. It was, CEO pay in the 40s used to be about 40 times average worker pay. And in some of our biggest corporations, it's 2000%. It's just off the charts. Board diversity and sustainability reporting are other key issues. I put this slide in to show you a website. It's the Forum for Sustainable and Responsible Investing, because I think the best thing we can all do as investors is to align with managers that are doing this engagement for us. So we at Fundex apply the very same screens we do to other funds, which are performance-based. As I showed you in the last presentation, what we're doing is classifying funds by risk and assessing their current performance. So you can do that with any universe of funds you choose. This website, ussif.com, is the forum for all sustainable funds. So you can go on there, and this is actually an active database. So you can sort by returns, assets. You can also, I'll go back here and show you. You can also see which managers are doing which screening and which advocacy, how their proxy voting is. Some people in this space only go with proxy voting. They will only invest with companies who have good proxy voting records. Vanguard used to have one of the worst, by the way. It was just last year that they voted positively on any of the environmental proposals that were put up. And it's changing rapidly. But here you can actually see how these companies vote, what they screen for, and their financial performance. So I encourage you, if you want to do the research yourself, really go here and take a look. There are 180 funds here, so you can pretty much find funds for any objective, whether it's fixed income or alternative. I put a couple slides to show you what BlackRock is doing, because in the ETF space, they have broad market ESG funds. You can see up here are the market cap weighted US equities, large and small, IBB and AJR, and here are the sustainable ETFs. Large blend, small blend, foreign, large, diversified, emerging markets, and bonds. Another site, well, before I bring that up, here's another slide showing you an ESG model from BlackRock using their funds. This would be a typical 60-40 client portfolio. And this is how they would allocate it. So this is not based on performance, such as what we do at Fundex. This is simply more or less an index asset allocation 60-40 portfolio, but it's all invested in ESG screened funds. So green bonds are certainly growing. Green bonds are poised to be $1 trillion. Wow, this again is an older slide. It's grown since then. So getting started with sustainable investing, I think the best I can do is really show you what we've struggled with over the years. The explosion in demand for sustainable funds has certainly led to a much broader universe of dedicated SRI, ESG, and impact funds. So new research really allows us to evaluate nearly all funds based upon their sustainability or ESG scores. And you can do that, and we do that with Morningstar and MSCI ratings. So you can apply any strategy. We apply our strategy, our time-tested upgrading strategy, to the entire universe of ESG funds and stay in the top performing ones, the ones that have the strongest recent performance. So the funds that are doing relatively well. There's momentum to this. You know, we've proven to ourselves over time that once funds achieve excellent performance. They continue to do well for a finite but limited period. So we believe that you should not just stick with a fixed asset allocation, rather choose your funds for environmental and social impact that also have good performance. We are not passive investors. I know, active investing is not for everyone. And if you don't have a lot of time to devote to it, I believe that you should align yourself with a company that is doing a great job of engaging and screening themselves and invest in their funds. I put this up for anybody that missed it before. If you want to get information about our sustainable fund or how we do it, you're welcome to call the office or sign up for Fundex Insights. If anybody wants a list of the funds that we have deemed to be the best sustainable managers that actively engage with companies, you can email me or call the office, and probably email janet@fundex.com, or just go on the website and call the office and leave your name with whoever answers the phone and your email address, and I can send you a list of those. I meant to get time to go and copy it and put it in the presentation, but I didn't. So leave your name and I'll be happy to send it to you. Because I think for most of us, there are so many options among good sustainable funds. I just think, these fund managers, sort of like what we did with the whole fund industry for the last decade, we relied on the managers and their research teams. I think most of us individually just can't compete with a team of research analysts that are not only doing the research, but engaging with the companies, doing all the voting. So companies that I like, I showed you in the last presentation, Pax World is a big one. Domini is a big one. I'm reluctant to change my screen and show you now, but the funds that were invested include about 75% of them are screened. Brown Advisor Sustainable Growth is a terrific fund. Calvert funds do a wonderful job. I mentioned the iShares. There are 180 funds on that US SIF website. In fact, so I did put that website on there for you to see. Most all of the funds that are doing a good job with sustainability in this country are on that website. So that's a good way for you to look at it.
Janet, there are some questions, but one of them I'm going to list because it sort of alludes to some of the issues that have come in with ESG funds in the past. And it is, do new ESG funds avoid the old funds issue of discriminating against women and others in the name of, quote, religious family values, unquote?
Oh, that's a really good question. And it's an interesting one to me because I have clients, an old Irish Catholic family that is very progressive and only committed to investing sustainably. And they will not invest in any sort of Catholic values funds that do not support women's health issues and birth control and stuff like that. So that's way, way in the past. None of the, I can think of one fund out of about 200 that still holds those values. But there are a variety of them. I mean, there's a fund called Amana Growth that actually uses Muslim values. So they do not invest in lenders. You know, they don't like the interest model. So there are a variety of them, but no, very, very few. In fact, all the funds that I invest in, and most all the funds in that list you'll see, have promoted governance and social to the top of their priorities, so that governance really means diversity, not only on the board, but in upper management. It means equality. It means paying workers fairly. There are one or two religious funds still around, and that person can email me if they want the fund to avoid there, because there were a couple of, you know, kind of old-fashioned valued funds that didn't want to invest in birth control and things. There are still some funds that divest from weapons of mass destruction. In fact, our own fund does. We have a fund, SRIFX, and one of the screens is for-profit prisons, and another is weapons of mass destruction. These dirty nuclear bombs and that are used on people, and you know, several funds still screen tobacco, and but I think weapons for-profit prison is fairly common.
There was an earlier question about ESG ratings are super problematic, cannot be trusted. So what other ways to evaluate these companies?
Yeah, that's kind of the conclusion that I was trying to get across. There's not consistency. There's a lot of difference in ESG ratings. Materiality is such a big issue. I do want to emphasize that I think it's only a starting point. I think that it's a good place to start, but you've got to do your own research. And if you don't have the time to do your own research, I highly recommend aligning with a very reputable, sustainable fund manager that has a whole team of researchers doing their own research. I will say that even fund management companies that do not label themselves as sustainable are paying more and more attention to materiality of ESG issues, because it's a risk management tool. So when I talk to people at many of the value funds, like Oakmark is a good example because they've been around for so long, they pay attention to it. Certainly Brown is a good one. Locally, Parnassus. Most all the big companies do have specific sustainable funds now, but I think if you align yourself with a company like Calvert, for instance, that were pioneers in the industry, they probably have 15 or 20 funds to choose from, and you can be darn sure that they are doing the training and have whole teams of researchers on it. And they're also really up on the voting. and they're advocating with the companies that they invest with. So that's really the most powerful way to do it. Our fund, SRIFX, is a fund that not only screens for the effectiveness of the manager and the ESG score, but also performance. So you get kind of a double layer of management that way. And, there's some people that just want to be passive, and you can buy the passive ETFs. It's not perfect by any means, but it's a great start. I think the fact that we're all doing this and going forward with emphasizing where we put our money matters is being heard. The change in the industry over the last 5-10 years is absolutely remarkable. Reporting is getting better. And I think the rating system standards I know they're in development. They're still being talked about. We will eventually get accounting standards. Materiality as an issue is not going to go away. For an oil company, it's quite different than for a tech company, what's material. But I think it shouldn't be dismissed because it's an excellent starting point, even though there are differences. So I think that as a risk management tool to increase performance and also to send a message to corporate America, I think it's a very important tool.
There's a question here that is part of the, I guess, crystal ball type questions.
Yeah.
Would you venture to make a guess at where stocks might be at the end of 2022, maybe using the S&P 500 benchmark?
I've spent my life saying I'm not a forecaster. My job is to identify what's working and follow it. But it's been a brutal year. I read all the analysts out there. I like Bespoke, which is big on historical data. They say we can't forecast the future, but we can look at history. Historically, every time a year, the first 50 trading days has started out as negative as they have this year, the year has ended up positive. When I look at the efficiencies of corporate America gained over the last couple of years, and the very strong corporate earnings. I'm not sure I put in a slide about corporate earnings, but even with all the troubles, corporate earnings are strong. So I would venture a guess that I do think decade-long returns are certainly going to be far below where they were, but I think that we're going to have a rebound and see a pretty positive year. So that's really, it sounds crazy looking at all the negative slides I showed you today, doesn't it? But there you go, markets are unpredictable.
Well, what about some people predicting recession next year?
I did put in a slide showing that, I'm just going to stop sharing now, showing that, and there was an old joke about how many recessions have been predicted that have never come about. It's a tough environment. The Fed doesn't have much room to do anything. I mean, they've got to raise rates. I think if it's done reasonably, corporate earnings can handle it. I don't think that the Russian economy is going to affect us much. The peace dividend going away is going to mean that everybody's budgets are altered. And certainly we're all going to be spending more money on a new Cold War. But I think that efficiencies in corporate America are likely to keep earnings pretty strong, and earnings are still terrific. At the end of the day, stock prices eventually catch up to earnings after they shake off the geopolitical upsets. I think I started out, talking about Jeremy Siegel and many other people warning us not to believe that markets really follow these big news events, because they don't. There's immediate sell-offs and then markets go back to their fundamentals. That being said, the fundamentals of increasing interest rates are a challenge. I really do think for our own clients, we've been moving more and more into alternatives. Not that we're going away from equities, but, and there's always something. I think the beauty of our system is when value funds do well. I remember when the tech bubble burst, our system led us into small cap value. We actually had positive returns in 2001 and 2000, not because of our insight or forecasting at all, simply because our system of measuring what's working got us out of growth and into value, out of large cap into small cap. So following these trends in a systematic way, I think is one way that you can avoid the worst hit areas. I'm just reading the chat myself. How do you see the market affecting the housing market is a good question. The housing market is certainly strong and was stronger because of the tremendous gains in stocks over the last decades. And clearly when interest rates go up and people's portfolios lose money, they have less confidence to buy. But the analysts in real estate and those that are looking at real estate think real estate is one of the attractive areas right now. So I haven't heard anybody actually be negative about real estate. It seems unbelievable sitting where we are in California, the affordability index and people losing money and interest rates going up, but demand is certainly great.
Anybody else have any questions? Janet, I love the way you've covered a whole bunch of subjects and just given us your insight and expressed your opinion, which is, I think, very, very useful.
Yeah, well, thank you. I wish there was an easier answer to the whole sustainable investing, but there are lots of people doing it really well, but it takes a huge amount of research. So align with somebody that's doing it well, I think is my best advice there.
Well, good. Well, thank you very much for presenting, and thanks to everybody who gave us questions and made comments, and good investing to everybody, and enjoy. I don't know how some of you are probably not in sunny weather, but in California, it's very nice. So take care.
Okay. Bye-bye.
Thank you.